Let's do a quick overview of the 2-1 buy down product. Actually, all the buy down products. There's several of them. All of them work very well within the Fannie Mae loan limits. So our maximum high balance for Fannie Mae right now is $891,250, and in the new year that is going to go up, and that is to be determined yet. But I just wanted to share that with you that that's going to be changing. So as we're working with clients and working with purchase prices, we want to be aware of that. It doesn't mean that we can't use maybe a combination loan, like a first and second, to be able to get into that higher purchase price range. But I just wanted to make you guys aware that this works really well on Fannie Mae product and loan limits using Fannie Mae, Freddie Mac, FHA, and USDA. So we can use that on all products. And I've got another screen over here that I'm going to share with you guys.
So Jeff, that's for King County?
King County, Pierce, and Snohomish.
Oh, same thing. Okay.
Yep. Great question, Kitty. Thank you.
Mhm.
All right. Okay. So I wanted to share with you, this is a spreadsheet that we've made at the branch, and it's a helpful tool to be able to calculate these buy down costs on the fly, right? So we can enter in the purchase price. In this particular case, it's going to be a 20% down scenario. We can do as little as 5% down on our Fannie Mae product. So and then 3.5 on our FHA product. And then if we're out in rural areas, USDA has a 0 down opportunity as well. So you can actually say that there are 0 down products out there. Now, you can see we've got several different options of buy downs. There's the 3-2-1, there's the 2-1, there's the 1-1, there's the 0-1. And I'm going to just focus in on the 2-1 buy down, because right now it's been over the last 9 contracts we've used a 2-1 buy down to successfully help people into a home. A little bit of the why behind this real quick is, so on the buy down product, well, let me just run through an example and I'll go through some of the why and some of the scripting that we're using to help articulate this to buyers, and then something that you can use with your sellers as well. Okay. So we're looking at the 2-1 buy down. Okay. And how it would work is, let's just say the interest rate today on a 30-year fix is at 7.25. What we would do is we'd position the buyer to have an interest rate of 2% below the interest rate in year 1. And then in year 2, it would be 1% below the interest rate. And then in year 3 through 30, it would be at the interest rate that we locked in at. And what we're essentially doing is we're asking the seller to pay prepaid interest for the next couple of years. And so the calculation comes out to be, in this case, about $17,000, right? And so we would position our offer on this particular purchase price of $900,000, and we'd ask the seller to pay for $17,000 for closing costs for the buy down. Some realtors are trying just to make it simple and ask for the $17,000. Others are putting in there some language about the buy down. Either way is fine. Okay. We want to make sure though that we're in the interested party contribution limits. And is everybody Facebook friends with me? If not, by all means, ping me. And I do have this cheat sheet out there on Facebook. And if you would like a copy of the cheat sheet, I can absolutely email it to you as well. But in this case, we're putting it's a loan to value of 80% or 20% down. So we could get up to 6% in seller contribution for this particular scenario. if it was greater than 90%, or if it's less than 10% down, we would be restricted to 3% for seller contribution. So when we're looking at this, I've got my eye on this number and the purchase price. So 16,971.7 divided by 900,000 is about 2%. It's 1.89%. Okay. So that falls within all of the maximum interested party contribution limits for any of the scenarios that we have, right? And how we're positioning this is with the seller is if they're going to take a hit on their net proceeds, maybe it would be better to consider using something to help the buyer buy or attract more buyers as a result of this offer so that they can move their property quicker. On the buyer side, it's pretty evident, right? We've got almost $1,000 less a month on their monthly payment in year one, almost $500 a month less on their monthly payment in year two, and then it would then they would go to the actual interest rate for the remainder of the loan. Okay. So one of the great things, if you consider this is really cool, is this money here, unlike a discount point, it doesn't evaporate at closing. This money actually lives in almost like an escrow account, and it gets used up every month, a portion of it. So the scenario is if you have the next 1 to 2 years while we go through this economic cycle and rates drop to a favorable level, then you can refinance the property. And then whatever's left over of this $16,971.70, that actually gets applied towards your principal balance. So it doesn't evaporate immediately like just buying down the rate right away. And I like this because it gives the buyer the opportunity to buy at today's price. And then over the next 2, 3, 5 years, they will have built up some wealth because they bought a property today versus waiting till some nebulous time in the future, right? And then the added bonus of having this interest be part of potentially part of their refinance opportunity. I'd like to stop here a little bit and open it for Q&A to clarify any part of these numbers. What do you guys think?
So you were saying that the money is held in a separate account that's tied to the client's account?
That's a great question, Kitty. I don't know if it's held in a separate account, but it's baked into the loan and accounted for as time passes. It's like the equivalent of, let's say, an FHA upfront mortgage insurance premium that doesn't get used right away. And if they refinance to, say, a conventional mortgage, a portion of that upfront mortgage insurance premium gets refunded to them.
Okay. So they're not earning there's not any interest being earned on that money?
No.
Okay.
It's all baked into the loan.
Gotcha. Okay.
Any other questions, guys?
So how do you, so is it still a percentage of the leftover money that would be applied to, does it go to a refund or applied to the next purchase or the refi?
Great question. So any unused interest in this account, for lack of a better phrase, would be applied towards the principal balance. So let's say you use 6,000 of it, well then 10,971.70 would be applied towards the principal reduction at the time you refinance or sell the property.
Okay.
right? Whereas if you use this money for 2% to buy down the rate for the life of the loan, they'll never see this money. Like it doesn't, it just goes away. It's part of the transaction at closing.
Is there any prepayment penalty or restrictions on when they can refinance?
No, there's actually not. The request is, so if they make 6 payments on this loan, then that would be a great courtesy for us, but there's no prepayment penalty. But if they pay it off or refinance it within the first 6 payments, in the lending industry, it's as if you never did the loan. So we'd have to pay back the money earned.
But Jeff, I mean, my understanding and what I'm hearing is that the feds are going to raise rates in November and December.
Oh, yeah. Yeah.
And so the likelihood of our rates going down, maybe in a year, right? But I don't know, maybe they might go down in 6 months. I don't, what are you seeing?
Great question. And unless anybody has any additional questions on the mechanics of the buy down, then I'll kind of have a candid conversation about Fed funds, how this works, and address that a little bit. So as our goal here and the Fed's goal is to lower inflation. That's the whole point of everything. Why we're raising rates on Fed funds. So and it takes about 3 to 6 months for the Fed funds increases to bake its way through the economy. And so they're doing what they should be doing. And it may have been a little reactive. Maybe they should have done this a little bit sooner to head off the inflation that we're experiencing currently. But they're doing it now. And they've already telegraphed that 0.75% is going to happen in November. And that's a good thing for inflation. They're also in a position right now where they could break the economy if they do too much too soon, right? So they've been talking about 0.75% in December, but there are some Fed, members of the Fed that are saying, hey, let's take a look at this and maybe consider 0.5%, because there could be some unintended consequences about what's called margin calls, right? And we don't want that to happen, because that would put the bond market into a more dangerous situation. And without getting too detaily about it, it would be bad. So it's really good to hear the Fed actually talking about, let's not break the economy, but let's make sure and get the inflation squared away. So as professionals, we need to be paying attention to the PCE and the CPI indexes in November and December, and being able to speak to that. So as we're talking to our clients, we want to be able to articulate that the Fed funds that are increasing are not actually creating higher interest rates for mortgages. The mortgages are higher as a result of inflation being high. And the Fed is doing what they need to tame inflation so that rates start to come back down again. So once we hear that inflation numbers are starting to come back down, that'll be our bellwether of when we can start to see things dip, right? Because inflation is the main cause of why the interest rates are where they're at today. Questions on that? Does that help?
Hey Jeff, which camp are you in? Are you of the mindset that we're going to have a softer landing, or the latter, and these guys continue to just force the issue too much, which then just creates more of a mess than what it really should be?
I don't know. The 8 ball says unclear, try again. So I'm of the mindset and the hope that we've got some, men and women on the Fed that are paying attention to that, and they're listening to some of the experts that exist in, the bond markets and in the stock markets, and saying, hey, we need to be aware of some of the things that could break. And there's some indicators that there are some people in that camp. I tend to be in the, if I'm formulating an opinion, it's always easier to look back and have an opinion, but we probably should have started the Fed funds increase a little bit sooner to get ahead of the inflation. And hopefully we don't turn up the dial too much and have it be a more exacerbated problem.
So Jeff, you said that there was two numbers that we need to look at. The CP, what did you say? CPA? No.
CPI
CPI. What's
and
that?
PCE.
Consumer price index.
Oh, the consumer price index?
Yeah. And
Okay.
the markets tend to pay attention more to the core numbers, which is without, certain numbers baked into it. So if you're paying attention to the news, you want to be paying attention to CPI when that comes out, and then core CPI and core PCE and core and PCE itself. A little feedback. I baked into my presentation a little bit of language on how to talk about this with your buyers. Is it clear on how to reverse that with sellers, or would you like me to go over that again, or what are your collective thoughts?
You can go over it again. That'd be helpful.
Sure. So I'll do both. So on the buyer side, the way to be able to articulate this is, hey, we've got some great lending opportunities now, and I'm finding that prices are becoming, it's actually easier to buy a home these days than it ever was. So if you think back to March and April, we had 10 buyers for every house. Right now, we can actually negotiate a purchase price. We can ask for seller contribution, which then would help you with some of the cash flow concerns and the interest rate concerns that you might be feeling. And one of these products is called a Buydown, and there's several of them. One of it is called a 2-1 Buydown, where you actually start 2% below the current market rate, and then it goes up 1% per year until year number 3. And then you are, in the meantime, you've purchased a home that's valuable and in today's marketplace, so that when next year or the year after, when the values go up and inflation gets tamed, you can refinance with a little bonus. Not all of this money that is being baked into your purchase price would be, or your closing costs would be wasted. Actually, a portion of it would be would reduce your principal balance, which would help with the refinance. And then you're growing your wealth by buying in today's marketplace, and then positioning yourself for a better cash flow situation once inflation gets tamed. So that's on the buyer side. It's kind of long, but essentially you're trying to provide solutions and educate your clients. And if I can help you in any way on that, just to show some snips or numbers, then absolutely, I'm here to help with any of your buyers. And then on the seller side, when you're having those price reduction conversations, it may be a good idea to talk about the opportunity to give seller contribution. Because if you're faced with a price reduction of, say, 3%, just throwing this out as an example, or you could give a buyer 2.5% to help them buy this home, then your net is a little bit better. So we want to be able to articulate the net proceeds to the seller in giving the buyer something to help them with their payment. So you can kind of position yourself either with the seller or with the buyer. If you have to have a conversation of courage with the buyer, you can talk about the buy down and how that can help them with their cash flow over the next couple of years. The next thing, and then if you're having conversations about price reductions, you can bring up seller contribution as a way to attract some more buyers. I got one more minute. I'll stick around if anybody else wants to talk offline, but I want to make sure I keep you guys on task and respect your time. I have some flyers for you readily available. They can be co-branded at any point in time. This gives an example of, it's at 6.5% on this particular one, but the whole point of having this flyer is to have some opportunities to chat with clients, post on your Facebook, communicate with your past clients about the opportunities. And then there's this flyer too. I only have like 500 options of flyers, which makes it a little bit difficult to choose. But this is another example of how to have something at your open houses for conversations or attracting some new buyers that are curious on how to make it work in this particular market. So there's, all the buy downs are here. It is meant to prompt people to have conversations with you so that you can help them out. And I'm at the bottom of the hour and wanted to honor you guys with your time. And then everybody has my email. If you want support material or flyers, feel free to reach out. If you want to hang back and ask a question privately, I'm happy to hang. Otherwise, this is hopefully this has been very helpful in exploring some of the mechanics of this and how to position it. And that would be my intention. So I hope it made my intentions today.
Thank you so much, Jeff.
Yeah, thanks, Jeff.